Hi, good morning. It's Ty Smith of Manulife Securities. Alongside me is my partner, Mark Hamel, and this is the Friday 5 with Hamel Wealth Management. Joining us again is Mike Greenberg of Franklin Templeton Investments. Mike is VP and Portfolio Manager and also heads up Franklin Templeton's Multi-Asset Solutions, which is a core holding across our client portfolios. Mike, you recently chatted with us about the recent market downturn and how we arrived at where we are today. So perhaps we could talk a bit about what a potential road to recovery might look like, as well as any specific sectors or countries that you see leading that path forward.
Sure. Yeah. We've all had to become somewhat medical experts, I guess, a little bit, because the recovery is clearly going to be hinged quite a bit on how quickly the social distancing measures and the containment measures are able to be loosened. As we can let people get back to work, as people can go out to restaurants again, as kids get back to school, obviously that will create the spending that will get the economy kind of going again. Our view is it's going to be fairly slow and conservative. The fear, of course, is you let people back too quickly and you see a second wave of virus forcing you to kind of shut things down again. That being said, there's risks to either side of it in the sense that, with the amount of people working on treatments and vaccines, who's to say that they don't figure out something in the next couple of weeks and we can get back to work a lot quicker than we think. The opposite, of course, is potentially true as well, where it could be a little bit more prolonged than we think as well. So our view is the economic recovery is probably a little bit more of a U, in the sense that we kind of bottom out, and we're probably close to that now, given that we are already seeing a little bit of easing of some of those measures of as far as social distancing and containment. So we're probably kind of at sort of that bottom area now. There's still going to be some pain in the economy, but we're going to slowly get back to pace. Now, as far as what's going to work well, or where we want to focus on kind of going forward, I think that's going to be a very important part of kind of positioning portfolios going forward, because clearly some of those industries that were hardest hit aren't going to necessarily come back to their previous levels. Think cruise lines, think air travel, potentially even commercial real estate, as we all get used to working from home. I know a lot of companies would love that, and they could have a lot less commercial real estate downtown Toronto or downtown Calgary or downtown Vancouver, and save a lot of money. So there's going to be some industries that are probably not going to go back to where they were. On the other side of that, there's some industries that are blossoming because of this. Think of Zoom Media, think of Peloton, think of some of these other companies that are going to take advantage of kind of the virtual interactions of people. So we really actually think this is a great time to have some active management within portfolios. So when we build our portfolios, as it really is a combination of ETFs, more core fund holdings, and then more high active share, active mutual funds, which make up our portfolios. We really are looking for some of those active managers that we utilize to sort of seek out some of those sectors and industries that we think could very well profit quite well from this, but also avoid some of those value traps of companies or industries that look very cheap, but are potentially structurally changed in the sense that they're just not going to come back to where they were before. So I think that's going to be a key thing going forward as well.
So Mike, as you know, we're really focused on helping our clients, manage themselves through this correction and to help them take advantage of it for their long-term returns. Mm-hmm. What advice would you have to share with them about how to approach this and what to do during this time?
Yeah, and every investor is obviously different. I'd say the bulk of the investors that we deal with, and I'm sure the bulk of your investors, are people that have a little bit longer time horizon. They're typically not day traders within portfolios. So for those type of people that have that 3 to 5, even longer time horizon, really it's stay the course. It's not try to necessarily time the market. I mean, the worst thing you can do or could have done is sold out of the market kind of at those low points. And believe me, I had family members calling me asking whether they should cash out their RRSPs at completely the wrong time, of course. And we saw the same thing in 08, 09 as well. So there is going to be volatility in markets. That is the price we pay to go and seek out higher returns that we're going to get on our cash balances or even GICs. That's the cost, is volatility. If you can stay the course, if you can be disciplined and obviously we know your business very well. So clearly, all your clients have a financial plan, they have a goal, and they have a target, and they have a plan. It's definitely review that plan every year. Make sure that that's reasonable for your situation, but stick to it. Don't waver just because the market throws you a curveball. A lot of times it pays to not do anything. Sometimes inaction is sometimes the hardest thing to do, but can save you the most money. I mean, we've seen a lot of studies of missing out on some of those early rebounds after some of these big falls can really crimp long-term returns and the long-term value of the nest egg. And I guess the last thing I'd say is, we do definitely look at, the rate of return is very important, but the end goal is the size of that nest egg. And I think that's, where, we kind of come in as far as trying to get the rate of return at a reasonable level. But there's a lot of things that you can do as far as tax planning, insurance planning, estate planning that can really make that nest egg a lot bigger or a lot smaller, depending on if you make good or bad decisions around that. So it's really that full financial plan that's the focus, and not just that rate of return piece. Not to say that's not important, but there's a lot of other things around the edges that are key. And obviously, we love working with advisors like you guys because that's really how you've modeled your business. So I think that's the short advice, I guess.
Yeah. Thanks, Mike. That's a really powerful message, and it certainly echoes the conversations that we're having with our clients. Ty and I and all of our clients really appreciate you taking the time to join us today and share your thoughts and help them navigate these unusual markets. Mm-hmm. And for you, we want to say stay well, stay safe, stay healthy, you and your family. And to all of our listeners as well, our clients, we want to say stay safe, stay healthy, and we'll see you soon.
All right. Thanks very much. Have a great day.
Thanks again, Mike. Really appreciate the time.
All right. Take care.